Imagine a global leader in manufacturing heavy machinery for farmers and builders, grappling with economic pressures that could shake the very foundations of the industry. CNH Industrial's third quarter 2025 earnings report paints a picture of cautious optimism amid turbulence. But here's where it gets controversial. Are their strategies truly paving the way for long-term success, or are they just buying time in a market that's far from forgiving? Let's dive in and unpack this report together, step by step, so even if you're new to financial reports, you'll grasp the essentials without feeling overwhelmed. First things first, this website relies on cookies to function smoothly. Some are essential, like the ones that keep the site running without glitches, so without them, things just wouldn't work. Others are optional, and they can track how you use the site to tailor content to your interests, gather stats for improvements, or even help third-party services enhance your experience. These external cookies might be set by ads or analytics tools on our pages, used by those companies for their own purposes. To learn more about exactly what's being placed on your device and why, click Settings and more information. If you want to accept all optional cookies, simply hit Accept all optional cookies. Prefer to opt out? Select Reject all optional cookies. Or pick and choose the types you like, marketing, analytics, or whatever, and click Accept Selected to lock in your choices. Remember, you can always tweak these preferences later, giving you full control. Now onto the big news, released on November 7, 2025. This is an excerpt from CNH Industrial N.V.'s official press release titled CNH Industrial N.V. Reports Third Quarter 2025 Results. For the full scoop, check out the attached PDF here. https://preview.thenewsmarket.com/previews/cnha/documentassets/70731for.pdf, available on the CNH Newsroom. Key highlights from the quarter include consolidated revenues hitting $4.4 billion, despite a dip in overall industry demand and ongoing efforts to clear excess stock from distribution channels. Think of it as retailers unloading inventory to balance supply and demand, which can sometimes pressure prices, but help stabilize operations. Diluted earnings per share stood at 6 cents, a metric that tells investors how much profit the company made per share after accounting for all outstanding shares. Even with these persistent market hurdles, the results showcase CNH's strong focus on cutting costs wherever possible and pushing for top-notch operations, kind of like a ship captain steering through rough seas by trimming sails and optimizing the crew. Interestingly, they've bumped up their net sales guidance, meaning they're projecting higher sales figures moving forward. But on the flip side, they've lowered profit guidance, factoring in extra costs from tariffs, those trade taxes that can inflate prices on imported goods, and a sales mix that's geographically tilted in less profitable directions. And this is the part most people miss. How do tariffs, often imposed by governments to protect local industries, really affect a company like CNH, which relies on global supply chains? It could be seen as a necessary evil for national interests, or perhaps an unnecessary barrier stifling innovation, who knows? CNH Industrial N.V., traded on the NYSE as CNH, announced its figures for the 3 months ending September 30, 2025. Net income totaled $67 million, with diluted earnings per share at 6 cents. Compare that to the prior year, 3 months ending September 30, 2024, when net income was $310 million and diluted EPS was 24 cents. Consolidated revenues came in at $4.40 billion, a 5% drop from Q3 2024, while net sales from their industrial activities, the core business of making and selling machinery, were $3.70 billion, down 7% year-over-year. On the cash flow front, operating activities generated $659 million, and industrial free cash flow absorption, essentially how much cash was tied up in operations, was $188 million for the quarter. In the words of Chief Executive Officer Gerrit Marx, while the current trade environment remains challenging for our farmers and builders, CNH continues to take decisive actions to navigate near-term headwinds. We are maintaining disciplined production levels, reducing channel inventories, investing in technology, and driving operational excellence. Our commitment to quality and innovation is unwavering, as demonstrated by recent product launches and industry recognition. Looking ahead, we remain focused on achieving our long-term strategic targets. I am confident that the steps we are taking will position CNH for renewed growth and success as market conditions improve. These remarks underscore a company doubling down on smart moves, like cutting back on production to avoid overstocking and pouring resources into tech advancements. For beginners, this means they're not just reacting, they're proactively shaping their future, perhaps by developing smarter tractors or construction equipment that use AI for better efficiency. But here's where it gets even more intriguing. Is this confidence justified, or is it a classic CEO optimism that could clash with reality? And what about those tariff headwinds? Should governments rethink these policies to boost companies like CNH, or do they serve a greater good? We'd love to hear your thoughts. Do you agree with Marx's outlook or see red flags in the numbers? Share your take in the comments below. It could spark some lively debate.